Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. Friday, March 6th, 2026, the market got a contradiction it just couldn't ignore. Jobs looked weaker, oil ripped higher, and stocks traded like inflation was the bigger threat than growth. This was a risk-off session with a very clear tell. When the tape turned, it didn't just hit the fringe, it hit leadership. Semis and high multiple tech took the first punch, and then the generals, mega-cap tech, went red too. That's when it stopped feeling like a rotation and started feeling like de-risking. Defensives helped cushion the index, but they didn't change the message. Traders were paying down exposure into the weekend, with volatility lifting into the close. On the S&P 500 Heatmap, the story was visual. It was a sea of red, with the darkest pocket sitting in technology, especially semiconductors. And the key detail, there wasn't much upside masking. Mega-cap leaders were on the downside too, so index weakness felt honest. You didn't have a single mega-cap propping up the board. The green was isolated, and defensive utilities were broadly green. Staples held up, Costco really stood out, and selective healthcare caught bids. That's not broad confidence, that's shelter. That heat map translated into a very clean money flow message. Capital rotated away from long-duration growth, the AI chain, semis, high-beta software, and moved into low-vol cash flow. Utilities and staples weren't a momentum chase. They were a risk-control trade, and with geopolitical tension tied to the oil move, you even saw selective aerospace and defense names pop as hedges. One other piece you couldn't miss: small caps got hit hard. That's the market admitting risk appetite was fragile under the large cap surface. Here's the tension that defined the day. A weaker jobs read didn't deliver the rate cut relief bulls wanted because Crude's surge reignited the inflation story. So traders stayed pinned between slower growth and stickier prices. And the market didn't resolve that conflict. It repriced it. The adjustment showed up as pressure on growth and semis and a bid for defensives. And when volatility lifts into the close on a day like this, the psychology is clear. This wasn't a dip-buy session. It was a degrossing session. On chatter, the main narrative traders kept circling was simple. Higher oil acts like an inflation tax, and that's why duration got sold. There was also plenty of speculative talk about geopolitics keeping a risk premium in crude. More what if than confirmed fact, but it definitely shaped how fast people reached for defensives. Important qualifier here, there isn't a single verified chatter item we can point to as the driver, so treat this as context for positioning and psychology, not a confirmed headline cause. The so-called peace dividend just evaporated. This week, Brent crude didn't just move, it went vertical, screaming past $91 a barrel for the first time in years. We're not talking about a minor disruption. The market is starting to price in a structural threat to the Strait of Hormuz, the world's most critical energy artery. Look at the VIX. It didn't just tick up, it gapped higher by roughly 10%, signaling that institutional fear has officially replaced greed. From a tape reader's standpoint, this looks like a major flight to safety. The 10-year Treasury yield is pushing about 4.17% as investors dump bonds on inflation fears, while at the same time grabbing the US dollar as a life raft. This isn't a dip to buy yet, it's a geopolitical repricing. If oil holds above 90, the conversation shifts from soft landing to a hard stagflationary reality. Watch the energy names, but keep an eye on the exit door. If you wanted a Goldilocks jobs report, today was the opposite. The February non-farm payrolls just hit the tape with a shocker, a contraction of about 92,000 jobs. This isn't just a miss, it's the weakest reading we've seen outside a recession in decades. But here's the tape reader twist. Hiring stalled, but the unemployment rate only nudged up to about 4.4%, and wage growth stayed hot, near 3.8%. Why? Because the southern border shutdown has choked the supply of new labor, keeping wages high even as the economy cools. That puts the Federal Reserve in a brutal corner. They want to cut rates to protect the jobs market, but with surging oil and rising wages, they risk stirring up a stagflationary spiral. We're effectively in the stagflation zone. In this kind of setup, cash isn't just king, it's a fortress. The market isn't trading on growth anymore, it's trading on survival. NVIDIA dropped about 3%, and the importance isn't the exact number, it's the signal. This is the sentiment governor for the whole AI complex, and today it's sold with the tape as the session turned defensive. When that happens, traders stop treating every pullback as an automatic buy the dip. The AI chain stops being a safe source of beta and becomes the first place risk comes off. Micron was a clear standout on the downside, down almost 7%. In a tape where semiconductors were already the pressure valve, Micron's outsized drop looked like a stress flare. And the point here isn't a single stock story. When memory is leading lower inside semis, the whole supply chain starts to feel fragile, and it reinforces the market's decision to cut high beta exposure first. Apple slipped just over 1%, and that matters because Apple is where funds go when they need liquidity. On down days, it's often a source of cash. So seeing Apple red alongside the broader tech pressure reinforced the message from the Heatmap. This wasn't a narrow theme sell-off. This was real de-risking, with leadership participating. Amazon dropped nearly 2.5% as discretionary, and growth got sold on the same day. Oil was driving the macro narrative. When consumer-facing megacaps slide while crude is ripping, it feeds that classic fear traders talk about in real time. Higher costs, shakier demand, and less tolerance for high multiples. Today, that fear showed up directly in the price action. Lockheed Martin gained about 2.5% in a session dominated by oil and macro anxiety. Defense strength looked like a classic hedge flow tied to elevated geopolitical risk. The bigger takeaway is the contrast. While tech and high beta were bleeding, this was one of the few places buyers showed up with conviction, less about upside chasing, more about protection. Looking ahead, next week's setup is all about whether the inflation data validates what oil just threatened. Wednesday brings CPI, a major volatility catalyst for rates and growth multiples. Thursday's initial jobless claims either confirm softening labor or ease some recession anxiety. Then Friday is stacked. Core PCE, preliminary GDP, durable goods, JOLTS openings, and preliminary Michigan sentiment and inflation expectations. Through all of it, the market will keep treating energy as the macro volume knob. If oil stays elevated, the tape stays defensive. To wrap it up, the market didn't get comfort from weaker growth signals because oil kept the inflation impulse alive. That's why the tape punished duration and rewarded survival. Next session, don't just watch the index. Watch whether semis keep acting as the pressure gauge and whether megacap leadership can stabilize without hiding internal damage. And keep oil on the screen, because right now, it's setting the rules of the game. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.